Hello and welcome to this webinar presented by the IFRS Foundation. My name is Ravi Abeywardana and I'm part of the ISSB Engagement team at the IFRS Foundation, and I am your host today. First, some housekeeping. Please do ask questions by clicking the Q&A button in Zoom, focusing on today's theme, which is climate-related scenario analysis. We won't be able to get to all of your questions today, and some might be outside of the scope of today's topic, but we will consider all of them in our educational efforts, including our webinars and other communications going forward. This webinar is being recorded and will be available by on the IFRS Foundation's Sustainability Knowledge Hub. We have closed captioning enabled. You can turn it on in Zoom. Live captioning or live closed captioning, sorry, isn't 100% accurate, but we hope it helps with the accessibility of today's content. Another quick disclaimer: the information and topics discussed during the webinar do not constitute implementation guidance by the IFRS Foundation. With that done, it's a huge welcome to everyone joining live from around the world, as well as those listening on demand. Here's a look at our registration numbers. We have just over 2,900 people joining from over 137 countries, spanning corporate sustainability officers, consultants and finance and reporting executives, as well as those from the accountancy profession and academia. As we go along, we'll post links to resources in the chat and also send them in a follow-up email along with a copy of the slides. Before we meet with our speakers, let's take a quick look at the key topics we'll explore in this session. Slide 4 provides a high-level overview of today's discussion. Today, we'll explore climate-related scenario analysis and resilience disclosure requirements under IFRS S2. Selecting scenarios, assessing resilience, disclosing decision useful information commensurate with a company's circumstances, from qualitative to more complex modelling. This sets the stage for our conversation on this important aspect of climate-related disclosure. Now, who will be our speakers today? To lead off our discussion in a moment, Veronika Pountcheva has been a full-time member of the International Sustainability Standards Board since October 2022. She brings an extensive international leadership experience in sustainability, corporate responsibility and diversity, with a background in both economics and engineering. I also want to welcome our guest speakers who will bring expertise from different perspectives. Today, I'm joined by Ellie Johnston, Director of Programmes at Climate Interactive, Evelyn Yong, Senior Consultant at Finity's Perils and Climate Risk Practice. She's also a member of the Climate and Sustainability Practice Committees of the Institute of Actuaries of Australia and the International Actuarial Association. And finally, we have Nisheeth Srivastava, Head of Group ESG Reporting at AIA Group. With that, turning to you, Veronika, for the first question. And that question is, what are the key elements a company should consider when preparing to conduct climate-related scenario analysis under IFRS S2? Could you particularly elaborate on the proportionality considerations in the standard that require an approach commensurate with the entity's circumstances, including how companies should assess their risk exposure and evaluate their capabilities and resources for scenario analysis?
Well, indeed, an important question, Ravi. IFRS S2 requires entities to use climate-related scenario analysis to assess their climate resilience, which is a critical aspect of the standards disclosure requirement under the strategy pillar of core content. While IFRS S2 requires the use of scenario analysis only in the context of resilience assessment, It is important to note that climate-related scenario analysis can be used to inform other disclosures required by S2, including the identification and assessment of risks and opportunities, estimating anticipated financial effects, developing plans needed to transition into a lower carbon economy. So let me talk a little bit about some key elements which entities should consider include. The first one, which I want to mention, is the purpose of scenario analysis under IFRS S2. Scenario analysis is a process for identifying and assessing potential outcomes under conditions of uncertainty. And this is a process which also helps entities understand the resilience of their strategy and business model to climate-related changes, developments, and uncertainties. The focus on this work is on providing decision-useful information to investors about an entity's climate resilience. The second element is about disclosure requirements in paragraph 22 of IFRS S2. Entities must disclose information about their assessment of climate resilience, including implications for strategy and business model, significant areas of uncertainty considered, capacity to adjust and adapt strategy over short, medium, and long term. Entities must also disclose how and when scenario analysis was carried out, including the inputs they used, the key assumptions they made, but also the reporting period in which analysis was conducted. The third element which I want you to consider is proportionality considerations, the commensurate with circumstances, which is under paragraph B1 of IFRS S2. IFRS S2 recognizes that entities have different exposures to climate-related risk and opportunities. And the standards also acknowledges that entities have different levels of skills, capabilities, and resources. And because of this, paragraph B1 of the application guidance specifically states that the approach should be commensurate with an entity's circumstances. The fourth element which I want to mention is assessing the risk exposure. Entities should evaluate the nature, type, and extent of their exposure to climate-related risk. And this includes both physical risks, like acute and chronic, but also transition risks, like policy, legal, technology, market developments. The severity, the likelihood, and the potential financial impacts of this risk should be considered. Logically, higher exposure to climate-related risk may warrant more sophisticated analysis. The fifth element which I want to mention is about evaluating skills, capabilities, and resources. Entities should assess their internal skills and their expertise related to climate scenario analysis. They should consider the available resources, including the financial resources for potential external support. Access to data, analytical tools, this is another important consideration. The standard recognizes that capabilities may develop over time. And the last sixth element which I want to mention is about the range of approaches. IFRS S2 acknowledges that scenario analysis encompasses a range of practices. This can range from qualitative scenario narratives to complex mathematical modeling. The appropriate approach depends on the entity's specific circumstances. And finally, the standard requires at minimum updating scenario analysis in line with the strategic planning cycles, which can be different from entity to entity.
Thanks ever so much, Veronika. That's great. Now let's turn to our panel to hear their perspectives on how scenario analysis is being used to assess climate resilience and inform disclosures under IFRS S2. And a reminder to our audience, after the initial round of comments, we'd love to take your questions. And I wanted to remind you that both the slides and the links to resources that would be sent to participants after this webinar. And you can always connect to us by emailing us at capacitybuilding@ifrs.org. So let's start with a question for you, Ellie. So, building upon Veronika's overview, IFRS S2 requires companies to disclose information about the inputs they use in their scenario analysis, including which climate-related scenarios the entity used, the resources the sources of those scenarios, and whether the analysis includes a diverse range of scenarios. As someone who develops climate-related modelling tools like On-Roads, what practical guidance can you offer companies on selecting appropriate scenarios from sources like the IEA or NGFS that represent different climate futures, including those aligned with the Paris Agreement, and how they can explain why these scenarios are relevant to assessing their specific business resilience?
Thanks for the question, Ravi. And maybe even just before I jump into directly answering the question, I want to ground us in even what a climate scenario is, because this may be unfamiliar language to people coming new to this field. So one example would be just in the coming decades, we know that if we don't take action, climate impacts will get worse. That's a scenario. Then another scenario is that the world does take lots of actions. We avoid the worst climate impacts and we achieve the Paris Agreement targets. That's a second scenario. These scenarios have two very different outcomes, and they also imply a range of different assumptions about what the world would need to do to lead to them. Different assumptions about economics, different assumptions about policy, investments, technology. And so when we talk about selecting scenarios, we want to be selecting that across that range of different possible futures at a very global scale oftentimes. And then, of course, then tailoring that and thinking about that for the context of what that might mean for your business. So then a scenario, as has been noted, could be created through a qualitative exercise or with the use of models. And even before getting into the scenario selection process, I'd suggest doing an assessment of the types of climate sensitivities that your company might be most exposed to or even just interested in. So, for example, some may be interested in how shifts in energy sources will play out, while others may be interested in different physical impacts of something like sea level rise. Doing this assessment up front can help guide the scenario selection and inform the methodology that you use, whether you want to take a more an approach with a model or use a more qualitative approach. And I think the other thing that is really key in defining these kind of sensitivities up front is that it helps you in the long run in explaining how the climate scenario exercise is relevant to your business. So then after doing that, select your scenarios. And the purpose, as Veronika noted, is to assess the potential outcomes under uncertain conditions. So you're going to want to select a wide variety of different scenarios to kind of put some bounds on the range of possible conditions. Very practically, I might suggest that at least one scenario reflects a path where what if current policies continue without a further level of ambition? We take the world as it is today and say, what if it continues as it is? This could be sometimes it's called a current policy scenario or a lower ambition scenario. Then I'd encourage taking at least one scenario that reflects increasing ambition at a level that is aligned with the Paris Agreement or net zero, some level of increased ambition. And then from there, finding at least one scenario, perhaps many more, that fall in between those first two scenarios. So you have current policies and then you have a high ambition scenario and then some sort of middle of the ground. And when it comes to picking these scenarios, there are a number of different resources out there. Ravi alluded to some of those sources like the NGFS or the IEA. They have established kind of off-the-shelf scenarios that can be taken, or you can use those as a starting framework and then build more proprietary or customized scenarios suited to your business. The tool that my team has developed with MIT Sloan is publicly available. It's called En-ROADS. It's a way in which you can tailor scenarios and then look at a variety of different assumptions and outcomes under that. So that's some of the ways just to get you started on this path of scenario selection.
That's fantastic, Ellie. So in summary, there's quite a lot of a lot of work to do in the background up front, which will inform a company's approach going forward. And then also selecting applicable relevant scenarios for the particular entity. Thanks ever so much. And here's another question for yourself, Ellie. Continue with scenario analysis implementation. IFRS S2 requires disclosure of inputs, key assumptions used in the analysis, as well as reporting period in which analysis was conducted. And based upon your experience with climate modelling, what guidance can you offer companies on documenting critical inputs and assumptions, such as energy mix projections, GDP growth forecasts, emission reduction pathways, and other key variables that are specific to their industry and business model?
Yeah, thanks for the question, Ravi. So one way to look at this could be to capture the different kinds of inputs and outputs of a scenario into a few different categories. And this, a lot of the times, the way I see this is it's a table of um, different scenarios and different columns with the different outcomes compared and contrasted. So one category would be things like your macroeconomic and your demographic inputs, things like GDP growth. Also, whether if you're using a model, whether that model considers things like damages from climate impacts to economic growth. Then also population growth scenarios. What are some of the assumptions that are underlying the scenarios there? Those may be consistent across your scenarios, or there may be some variability in them. Then the second kind of bucket of inputs to consider and to share would be around your policy and technological assumptions. This includes things like carbon pricing or assumptions about the availability of new technologies or the transition speed away from fossil fuels, perhaps. And these can really are oftentimes the big distinguishers across scenarios in terms of what that might mean in terms of transition risks. Then the third category I would bucket outcomes into is your physical factors. Things like oftentimes scenarios are characterized by their global temperature outcome. Otherwise, you could be looking at other types of impacts, sea level rise, extreme weather, different kinds of health impacts. And particularly for those second two categories of assumptions, that's where I would encourage thinking about what is that relevance to your business. And so, for example, if your business invested in food supply chains, then things like physical impacts around drought and water stresses are going to be highly relevant to the differences across the scenarios. If you're more in the utilities sector, then the different pathways for energy are going to be much more relevant. There will be things in these scenarios that may not be as applicable to your business. And that's where a lot of these scenarios open up, and there's so many different ways to drill down into. And so prioritizing, again, kind of starting with those initial, what are your climate sensitivities? What are your interests in the exercise will help guide that kind of coherent narrative around how this is useful for your business as an exercise. Um, and then in terms of gleaning and getting that type of documentation, if you're using an off-the-shelf scenario, you're going to rely on the published literature about those scenarios and what's out there. If you're using a tool like ours, like En-ROADS, you can pull a lot of that information just straight from the simulator itself, and even get a URL to the scenario that you're using, and pick and choose across the different outputs and inputs that you'd like to choose.
That's fantastic, Ellie. Really helpful there. I guess you stressed the importance of tailoring those inputs that are applicable to a particular entity. So once again, thank you ever so much. Now turning to yourself, Nish. There's often confusion about whether IFRS S2 requires complex quantitative modelling for scenario analysis. The standard actually allows for qualitative scenario narratives if they are appropriate to an entity's circumstances, with the expectation that companies can develop more sophisticated approaches over time. How has AIA approached this balance between qualitative and quantitative methods in your scenario analysis? And what practical advice would you give to companies that are just starting their scenario analysis journey and may not yet have the capabilities for complex modelling?
Thanks for your question, Ravi. So at AIA, our approach to scenario analysis has evolved significantly over the past few years. So we have been balancing between the qualitative and quantitative methods, and the objective has been to build a very robust understanding of the climate-related risks and the impacts that they have. So we started by doing high-level qualitative assessments, which were largely top-down and strategic in nature. So these were to help us understand the broader implications of climate on the business model, particularly in terms of the physical and transition aspects. And this initial phase was very critical because it allowed us to understand and identify the areas of the business that were most exposed and where we needed deeper analysis. So once we had this strategic view way early, when we moved into the detailed scenario analysis, which combined both the qualitative and quantitative modeling and insights, and for example, we used climate risk models to assess the impact of specific asset on specific asset classes and different business units as well, while we, in parallel, also kept on incorporating some of the stakeholder perspectives and the expert judgment to interpret the results meaningfully. Now, at this stage, what we are doing is that we are expanding both vertically and horizontally. Vertically, we are drilling down at business unit level, trying to understand what are the risks. And horizontally, we are applying more and more sophisticated climate models across the investment portfolios. Throughout the journey, I think speaking from disclosure standpoint, and especially from ESG reporting piece, throughout the process, we have embedded a very strong governance rigor in the process because, so for example, our ESG committee oversees the climate matters, reports it periodically to the board. We also have been building capacity across the senior management to ensure that climate literacy is at the highest level of decision making. So I think these are some small pieces that come together, and then they can help solve the jigsaw puzzle which comes across. So just to quickly summarize some of the practical advice that organizations that are just embarking on that journey probably start with qualitative assessment, because the idea here is to understand how climate risks could impact your business model. This will be different for every company, every industry. For instance, a P&C insurer will have a completely different view to climate risks than a life and health insurer. And now use those insights to identify what are the material risk areas for you, and then layer in a quantitative analysis that can genuinely add value to your assessment. And you don't need complex models at the outset. Focus on building internal understanding in terms of why are you doing what you want to do, and then set a strong governance system around it so that you do take the right steps. And in my view, engage your leadership quite early and build internal capacity. That is key to driving these assessments and leading to a meaningful impact. So it's not all, I mean, as I always say, that it's not always about like doing it in a technical way or getting it technically right. It's a strategic one, and you need to embed it correctly in the business decisions that you make. It's always about like, that this is scalable, insightful, and should always be aligned with your business priorities as well. Thank you.
That's really helpful, and thanks for the summary too. So, Nish, back to yourself, and now that we've discussed scenario selection and assumptions, let's talk about implementation. So, as head of Group ESG reporting at AIA Group, How have you approached integrating climate scenarios analysis into your strategic planning and risk assessment frameworks? And what practical lessons have you learnt that might help other companies implementing IFRS S2's climate resilience requirements?
Thanks for the question, Ravi. So for us, integrating climate scenario analysis and the whole strategic planning and risk framework has been a multi-year journey, as I said. It's deeply rooted now in our enterprise risk management process. So we started by embedding climate risk in our ERM framework, treating it as a material risk for both the physical and the transition view. And this allowed us to assess climate risks along with the other strategic and operational risks. And then this ensured that they are all considered in overall business planning. For us, one of the key enabler has been a cross-functional collaboration, because climate risk touches across everything. I mean, actuarial to investment, operations, sustainability, you name it. So we established working groups across these functions to ensure that there is an alignment, there is consistency in how we are interpreting different expectations, and we act on the scenario analysis output. One of the biggest challenges that we faced was around the data granularity and the limitations of the data that was available. So I think still the models are evolving, and the certainty of models is in progress. So for us, like for example, a lot of markets are interpreting it slightly differently. What are the expectations from IFRS S2, because there is a localized way in which it is getting nuanced. So we are building and tailoring our approach to deal with this local nuance as well. One of the way in which we tried bridging it was by launching a digital platform. It's called ESG One. This is a real-time tracking of emission data across our operations. And this has particularly improved our ability to monitor progress, identify the key hotspots, and support disclosures with confidence. And then obviously we are quite actively participating and collaborating with very many industry initiatives such as UNPSI. So this helps us also to give a reality check and help us benchmark and refine our approach and make amends as needed. So largely, I think I'll quickly summarize. So start simple. Don't wait for the perfect data models. Also begin with qualitative assessments and build from there. Understand the relevance and the materiality of it. Engagement will be the key. So engage your stakeholders in the journey. It's not that a single function should own it. It's owned by multiple functions, and therefore engagement is the key. Invest in setting up some kind of data support systems, because that can amplify your journey by giving you a granular view of your data and how data is moving. And then obviously, as I highlighted earlier, set the governance, which is foundational. Ensure there are clear role responsibilities and right set of management oversight, so that it just doesn't become like a checkbox activity, but it is about driving a meaningful impact with this whole assessment. Thank you.
That's great. Thanks ever so much, Nish. And now let's turn to the actuary's perspective. So Evelyn, IFRS S2 requires entities to disclose information about their climate resilience assessment, including significant areas of uncertainty they considered in that assessment. From your actuarial experience translating climate projections into financial effects through scenario analysis, what advice would you give companies to effectively identify and communicate the uncertainties inherent in their climate-related scenario analysis?
Thanks, Ravi. There are sort of three ways that I can think of for companies to identify that. In saying that it's quite important to disclose the uncertainties of your future assumptions or your inputs, as Ellie puts it, that will have impact on the resilience of a company. And I can go through the three ways quite quickly. So firstly, you could use sensitivity analysis on the critical assumptions within the scenario description that you have in terms of resilience of the strategy or in terms of financial performance. So in some cases, changes to these assumptions, you could find that when doing your sensitivity analysis, tweaking some of these assumptions could give you a very different outcome. And that's not necessarily very scary. It's actually sometimes quite useful to disclose some of these assumptions that are quite uncertain, because if you sensitivity test something and let's say you say the resilience of your company can be quite different if you assume you lose profitable customers versus losing less profitable customers. Obviously, you see a very different impact under the scenario. And that is very important because it gives your investors confidence that, number one, you are thinking of the uncertainties within your scenario, and number two, you are demonstrating the fact that you can model that assumptions differently, and hence demonstrate the different uncertainties within the assumption itself. The second way you could explore uncertainties is to actually through the use of scenarios themselves. So, for example, if you were going to expand via a different market or have different products, this would have been drawn out in your scenario design process. So Ellie spoke about that earlier as well, talking about what's important, your climate sensitivities, the driving forces that are important to your organization. You would have automatically put that into your scenario design. And through there, whichever is most important to your organization, you would have explored it through the scenario. So that's another way to bring that into the scenario. And the third way I could think of is you can actually also design scenarios specifically to explore different uncertainties. So the different drivers and the different narratives would give you different answers to what's important to your organization. I know you didn't quite ask how you would reduce or remove the uncertainties, or you can't actually remove it totally, but I thought I would mention it because it's something our local regulator actually recommends. So they recommend using something called the static portfolio assumption. I don't know if the audience is familiar with it or if you all are, but it essentially tries to isolate the climate change impacts in the analysis. So for example, if you take a snapshot of a business now and assume it is the same snapshot as in 2050 or 2100 or whatever it is, and you model your scenario as per your scenario, and without changing your demographics of your company, without changing your strategy or anything. And if you keep everything the same, you should see the climate change impacts being isolated within that scenario. And that's one way to reduce uncertainty within your scenario analysis. And like Nish was saying, try not to overcomplicate things. If you try to model it simply, keep everything constant except the climate change impacts, you should see the effect on your business.
Very interesting. Thanks ever so much, Evelyn, for that. And also, just going back to yourself, in fact, so drawing upon your experience in developing adaptation strategies and roadmaps for clients, what approaches have you found most effective for companies to assess and communicate their adaptive capacity across different time horizons in a way that provides decision useful information to investors?
Yeah, adaptive capacity is kind of an interesting term in a sense that if to put it simply, in transition planning or in scenario planning, the outcomes would ideally tell you which risk and opportunities are material to your business and how much capital is required to deploy to adapt to this risk and opportunities. So I guess as a natural next step, you would think about your transition planning. You would need to disclose how much capital is required to make the transition plan work. And so adaptive capacity really just describes how well a company adapts as part of the resilience assessment. So a good measure of adaptive capacity can be the amount of capital employed and the difference to your business as usual capital. So I guess the question is, how much additional investment is needed to maintain the resilience of my company under this climate scenario? And if it's less than your business as usual, or you can, or if it's affordably, like if you can raise the capital affordably, then you might say you're adaptive. But if the capital required is a bit way more than your business as usual, and what's affordable or available in the market, then you can say your adaptive capacity is constrained. That's how I understand it, Ravi.
Thanks ever so much, Evelyn, and all panelists, in fact. So with that, I think we now reached the stage when we can go into Q&A, and we do have quite a few questions which have come through. And perhaps I'll start off with Ellie. Here's a question which came through live. Can you please explain how climate or how the climate simulator might be used for certain industries, such as those in the oil and gas sector?
Sure. So when it comes to any scenario, as we're looking at climate scenarios, we look at where are the sources that are driving the climate risks that are so prevalent around the world. And the sources of those are the greenhouse gas emissions, and that largely come from the oil and gas industry. And so when you're looking at a lot of different scenarios, so for example, if you're using the climate simulator that we have En-ROADS, you can look at when does oil demand peak and begin to fall, and see that in many of these scenarios that are Paris aligned, that peak is quite soon. And so for the oil and gas sector, then there is a question of planning for that. And so then and thinking about what are the implications. So that's just one simple example, is the energy mix is very fundamental in a lot of these different scenarios. And definitely something that can be drilled into and say, okay, what are some of the types of technology that might enable a delay in that transition or accelerate it? What are some of the things around energy prices that drive that as well, in terms of companies? A lot of really interesting different variables that can be explored.
Perfect. Thanks. Thank you ever so much, Ellie. Now turning to yourself, Nish. So given AIA's presence across multiple markets, in particular Asia, um, how do you handle scenario analysis when your operations are spanning multiple regions and different climate policies and physical risks and transition pathways? So ultimately, I think what's being asked is how do you, what's your best approach for an entity which is global?
So, I mean, we operate across 18 diverse markets, and all the markets present different challenges and opportunities when it comes to the climate scenario analysis. So, because largely each market has its own climate nuance, and I mean, obviously, one size doesn't fit all approach, it doesn't work. So, the strategy is to empower the local business units to take ownership for their climate risk assessments. So, we encourage them by providing uh, a broad-based framework under which they operate, but we encourage them to develop granular market-specific views. And then these localized insights are critical for overall building relevance and credibility of the scenario analysis that we do. So what we have done at Group is that we have built a central framework that aligns with our ERM. This provides common principles, methodologies, assumptions that we have used, while it also has flexibility for local adaptation. And this is like kind of a balance between the consistency and the contextual relevance that we try to provide and empower our business units with. So, I mean, in general, the practical approaches would be to empower your business units or markets where you are operating to assess the risks that matter most to them, because that is a very nuanced matter. Obviously, have a consistent central framework that provides a high level guidance, but also has market specific adaptation possibilities. And as I said earlier, it will be very helpful if you are maintaining a centralized data system that can help you with collection of data and provide you with real-time analysis of some of the data pointers that can help you in taking effective decisions. Thank you.
Thanks, Nish. One final question. I think we can squeeze in another one from the audience, and this one is to Evelyn. So, how useful are disclosures based on proprietary scenarios? So, will users of the reports know how to compare them with other companies' disclosures?
I think yes, they would be able to compare. Because of the IFRS, they require one scenario. So the scenario outcome itself is saying you require a scenario that achieves a temperature outcome of, I think, less than 1.5 degrees by 2100. So that's one of the mandatory scenarios in Australia anyway. And then you are required to disclose under another scenario with temperatures above 2 to 3 by 2100. So in that sense, there's some consistency in terms of the outcome. How do companies get there is up to the companies. I would say short answer is yes, it's still useful because you are still required to disclose on your financial performance and your financial position, two of which are very much standardized already in accounting world. And that way that allows comparison across different companies, even though the different scenarios and the different driving forces are different to different companies. But at the very end, it's still about the process. It's still about how you embed it into your risk management framework. And it's about disclosing under the 4 pillars. And in that sense, it's still very consistent across different companies. I think it's still quite useful for people to compare it, even though it's different.
Perfect. Well done. Thanks ever so much. And now perhaps if we just pivot back to Veronika now. So we've heard valuable insights from panelists on implementing different aspects of climate-related scenario analysis. IFRS S2 acknowledges that scenario analysis practices may evolve over time. How does the ISSB envision companies progressing in their approach to climate resilience assessment as their capabilities mature, and what resources is the ISSB providing to support this?
That's an absolutely relevant and important question, Ravi. And we've heard excellent insights from our panelists today on various aspects of climate-related scenario analysis. And let me share some key takeaways especially for those preparers who are just beginning with this journey. And number one will be start where you are and with what you have, because the most important step is to begin the process of climate resilience assessment. Use the approach that is commensurate with your current circumstances and focus initially on qualitative scenario narratives, if that's appropriate for your capabilities. And remember that IFRS S2 acknowledges that practices will evolve over time. It's also important to focus on decision useful information, because the purpose of scenario analysis is to provide investors with information about the climate the resilience of your company, of your business, and concentrate on how climate-related risks and opportunities could affect your business model and strategy. Ensure your disclosures address the 3 key elements which are required in paragraph 22A of S2. Implications for strategy and business model, significant areas of uncertainty, and capacity to adapt over different time horizons. It's important also to leverage existing resources. And as our panelists have mentioned, there are many publicly available scenarios from credible sources. It's not just only one. Educational materials are available on the IFRS Foundation website as well. And industry association and peer learning can provide also valuable support. Consider starting with the limited scope and expanding it over time. As it was also mentioned, document your processes. Clearly document the input, assumptions, and the methodologies used, and explain why your chosen scenario is relevant to your business. Be transparent about limitations, uncertainties, and this documentation will support both disclosure requirements and internal knowledge transfer. Linking with strategic planning. The climate-related scenario analysis should not be a standalone exercise. It's important to align it with your strategic planning cycle as also required by paragraph B18 in S2. And using insights to inform strategy, risk management, and target setting is an important step. So this linking, this integration enhances the value of the exercise beyond compliance and informs also some of your business decisions. So how the ISSB envisions and thinks about progression over time? We think about capability development. We recognize that capabilities will develop progressively, and companies may start with qualitative approaches and move towards more quantitative analysis. And the depth and the breadth of scenario analysis can expand as expertise inside of the company's growth. The key is continuous improvement in the quality and decision usefulness of the disclosures. There will be evolving practice. Climate-related scenario analysis is an evolving field, and the ISSB is committed to monitoring development in best practices. So we'll continue to provide guidance and educational materials. The Transition Implementation Group, which is an important forum where we discuss questions related to implementation, will address the implementation questions. Proportionate implementation. The standard is designed to accommodate different starting points. As your capabilities in your companies mature, we expect more sophisticated analysis. However, the focus remains on providing decision useful information. And the approach should always be commensurate with your entity's circumstances. Continuous learning. We encourage entities to learn from their own experience and from others. And each cycle of scenario analysis should build on previous efforts. So feedback from investors can help refine the approach. And of course, the ISSB will continue to gather and share insights on effective implementation. In conclusion, while climate-related scenario analysis might seem challenging for those of you who are just starting out, it's important to remember that that's a journey. And the ISSB has designed IFRS 2 to accommodate different starting points while ensuring that investors receive the information they need to assess an entity's climate resilience. We encourage preparers to begin where they are and with what they have, focus on providing decision useful information, and develop their approach over time as the capabilities mature.
That's fantastic. Thanks ever so much, Veronika. And in summary, this is very much a journey, and we are encouraging disclosure wherever possible. So thanks ever so much, and to our panelists for your insights too. So thank you to everyone who participated today. Before we go, I'd like to remind listeners about some key resources to help you on your ISSB standards journey. The IFRS Foundation offers a number of programs and resources, including our website and our Knowledge Hub, with more than 280 resources from the IFRS Foundation and our capacity building partners. The IFRS Sustainability Alliance, a membership program for education tools and peer networking. The Fundamentals of Sustainability Accounting credential, also known as FSA, which instills the link between sustainability and financial performance. The IFRS Symposium on the 30th of October in London this month. And that will bring together global stakeholders to discuss the adoption and implementation of IFRS sustainability disclosure standards, with a focus on advancing the global baseline and sharing practical insights from regulators, companies, and investors. And finally, our main website at ifrs.org, where you can sign up for alerts. Please remember that that you can use our resources and participate in the program, and also supports our mission as a non-profit standard setter. And please do stay involved with the IFRS Foundation, including through this webinar series. Follow our LinkedIn and news updates to learn about more of our publications and projects. And you can also listen to the ISSB monthly podcast to stay up to date. And with that, I'm Ravi Abeywardana with the IFRS Foundation. And on behalf of the team here, thank you for participating. Until next time, thank you and goodbye.